You are listening to Investing Matters, brought to you in association with London South East. This is the show that provides informative, educational, and entertaining content from the world of investing. We do not give advice, so please do your own research.
Hello and welcome to the London South East Investing Matters podcast. My name is Peter Higgins, and today I have the pleasure of speaking with Stephen Yiu of Blue Whale Capital. Ni hao, Stephen.
Ni hao.
So, Stephen, it's been an absolute pleasure for me to have you on this Investing Matters podcast. I've watched your career for some time now, and you've had an absolutely monumental rise with regards to Blue Whale Capital, and the fund management industry has welcomed you with open arms because of how you've gone about your business. But I want to start, if I may, with regards to your journey. One was, of you as a young person, and I want to use a quote here from Marcus Garvey, the political activist and entrepreneur, once said, "The greatest possession of a man is his character." Stephen, what has helped you and made you the person that you are today?
That's a difficult question to start with. I'm probably going to speak for an hour on that. I think I've genuinely got a passion for the investing. I mean, in terms of investing on the stock market. And I recall when I first started my career in Hargreaves Lansdown, that's where I met up with Peter Hargreaves at the time. Obviously, I was fairly young. That was more than 20 years ago. But then I think as you go through your journey, if you keep doing what you think you really enjoy and hopefully you're good at it as well, then I think at some point you're going to do something, hopefully that would be of interest or maybe at a bigger scale. I think that's what I've tried to do with Peter at Blue Whale, and is trying to consolidate everything that I have acquired over the years and trying to put it in practice.
Excellent, thank you. I mean, what I find fascinating was obviously, I'm not saying you had a cushy time, but you had a really good job at Hargreaves Lansdown, and you're there and the markets are crumbling around you and everybody else around 2007, and you chose that optimum sort of time to think, now's the time for me to go into the fund management industry full stop, not just working within Hargreaves Lansdown as an investment analyst at the time. What were you thinking? And was anyone saying to you, Stephen, really?
Yeah, I think that was interesting, wasn't it? Because the years that I spent at Hargreaves Lansdown Bristol was until 2007, and I came to London to work at the time New Start Asset Management at 2007. And obviously, if people have followed what happened since then, or in 2008, a year after, then everyone knows that maybe that wasn't a good time to come to London or to join this new firm. But I think what hasn't stopped me is in anyone's career or life is I think controlling your own timing is impossible. Sometimes you just want, basically, if you're given the opportunity, you just want to pursue the opportunity, irrespective of whether you have a crystal ball, whether something would happen positively or negatively. And I think you can never control timing. And I think at the same time, if I look back at when Blue Whale was started in 2016, about 5 years ago now as a company, that some people would suggest that, you have picked a good time, because that was the time when many of these tech stocks, which I'm sure we can talk about, have just started to go up. But if you ask me, I would love to have started the business maybe another 5 years before. But obviously, 5 years prior to 2016, I wasn't ready to do so. So you can never time this, really. And luckily, we haven't started a business now, because I think if we start a business now, it would be slightly trickier, because then I think the environment is a bit more challenging, and obviously to be able to deliver the same level of outperformance that we did over the last 4 years might be less going forward. But still, I think we would do well depending on your time horizon. So.
You made an interesting point there regarding time horizon, but I want to come back to that later. I want to talk a little bit more about your time at New Star, which is now Janus Henderson, then Artemis, and then Nevsky Capital. Please can you share with us some of the fund managers you worked with during that time, what you experienced, and what were your greatest lessons during your formative time as a fund manager?
So I think it's a good one to kick off. So I have worked with a manager called Tim Steer for about 6 to 7 years throughout New Star Asset Management and Artemis. And at the time, we were running both a long-only UK fund and also a pan-European long-short hedge fund. And so people forget that I actually started my career as a UK fund manager, but at the moment, as far as the Blue Whale Growth Fund is concerned, we have no holdings in the UK stock market, which is quite different to what I kind of started out more than 10 years ago. And I think at the time, if you look back at the period for the UK stock market, we are talking about between the period 2007 until 2013-14. I think that was a period of time that it was, I think UK, we do have a lot of differentiated advantage as companies, overseas earners, exporters, industrial company, even like if you talk about like the oil and gas or mining company that have been selling quite a lot of commodities to China, that was a really good time. And at the time, I think I recall working with team, we always play this kind of theme in the fund that you long overseas earners, they're UK company, but then you are kind of short the UK domestics company, which would be typical the high street retailers, etc., that are quite low quality. And I think over that period, you can do pretty well out of that. But then, I mean, obviously, we can come back to this topic later that I think the era has changed. I think since Brexit, I think there's a lot of things that I think UK could have done better, but at the moment it's still dragging on for a bit. But at the same time, the US companies, the American technology company, have really taken a leap, and now they are shaping like how the rest of the world is going to live under the likes of Google, Microsoft, Apple, etc., etc. And I think at the time, what I have learned from team, which I think go through my career working for with Martin Taylor as well, is that in order to do well, you need to have a differentiator angle to your thesis. And obviously your thesis would need to be right so that you'll be rewarded with significant outperformance, because it could work both ways. If you get your research wrong, and then your differentiator view doesn't actually is going to take you to the wrong path. I think the challenge is always that there's so many competition in the market, and obviously I think a different time period in the market have a slightly different playbook. I think the end game is the same, that you want to have a differentiated angle, but then I think back in the old days when we are talking about maybe the information is less less widely dissipated at real-time context. So if you do get a chance to speak to the management, to learn a bit more about the business, you get to speak to some sell-side analysts, I think there's a lot of value that could add from an active manager perspective. But then I think with the kind of the introduction of MiFID II and also a lot of regulation in place, it's a lot more difficult to get an advantage in terms of doing some of the stuff that used to work before. But then the end game is always the same. And I think working with Martin for about 2 years at Nevsky Capital really taught me that. And Nevsky, if people don't know it, it was a long short global hedge fund. And obviously, if you're familiar with the hedge fund world, there's a lot of research being put in place, a lot of kind of resource in order to generate significant positive performance at the time. And so I think summarizing all that and just looking out to what we're trying to do here is, if you believe that to get significant outperformance potential is to have a differentiated angle, then at the same time you would need to have the conviction behind it. But how do you get conviction is you need to do a lot of research behind the scene. I'm sure you can come back to me on some questions, but at Blue Whale that we don't use any sell-side research. We don't speak to any sell-side analysts. There are 5 of us in the team and we do all the research in-house. So at least we can claim that some of our research are original, that hopefully that originality of the research would give us an advantage over our competitors.
You've come seamlessly to my next question, Stephen. So thank you for that. I was about to ask you the question with regards to what led you to set up Blue Whale Capital? You've already spoken about the differentiators, but I want to expand that, if I may, regarding you sharing with us the philosophy and the investment process behind Blue Whale, the differentiators, and its universe of stocks.
Yep, thank you for that. I think I already talked about that at the beginning. Is like I do have quite a strong passion or interest in investing, and I think one thing that you have also learned throughout your career, or at least my career, is in order to be able to to run a product that is quite seamless to what you truly believe in. Sometimes it's quite difficult if you are just a fund manager working for someone else, because I think one thing which is quite mathematical, and I think that is definitely one of the differentiator that when we first started Blue Whale, or Peter and I, we share this belief, is I think typically when you work as a fund manager, even though that there's a lot of franchise model across the fund management industry, that you might be running this product with your team, and then you would have this P&L that gets split with the parent's company, and then you would have a share within the investment team. But then ultimately running a long-only product, you would need to have you would need to run a lot of money to get a lot of resource on your investment team. And just imagine that when we first started in 2017, when we launched the fund, we were running 25 million pounds and we are charging less than 1% fee. I mean, you can do your own calculation how much income we were generating at the time. But at the time, Peter and I, we truly believe that if over time that we could deliver a product that people want with good performance, then between the two of us, we would need to invest into the product. And when we say invest into the products, it's not only seed the product with money. So Peter seeded the fund with 25 million pounds of his own money, but at the same time, you need to invest in the investment research team. So when we started off running 25 million, that there were already 4 of us on the investment team. And that is unheard of in our industry context. You do not get 4 headcount on an investment team running a 25 million pound fund in the UK. But obviously, if you ask me, could I have done it myself? Just me running it, 25 million, I guarantee you the performance would not be as good as what we have achieved over that period, because it's not just about the intelligence of some people running it. At the same time, it's a lot of hard work, a lot of research, a lot of due diligence that you need to take a lot of kind of brain power to understand what's going on in the world. And since then, obviously, the AUM of the Blue Whale Growth Fund has grown, and now we are running about $1 billion, and there are now 5 of us on the investment team, and we continue to look for new talent, and I'm sure at some point we might expand the team further. And I think that is the commitment that Peter and I have made, that we want to build a good product with good performance. And over time, I think some people would take an interest in the product, but it's a chicken and egg scenario that if I were just a fund manager at some other firm, it would just be myself. And I would never be able to come up with this product with the performance that we have delivered. So
I think it's absolutely amazing that you've delivered it anyway with just now 5. You know, never mind 4 at the beginning, you've got 1 more, and now you're sitting at an AUM of £1 billion, Stephen. That's absolutely amazing. So yeah, so I think it's fantastic. Now, you've not touched on a little bit of the area here regarding the universe of stocks. I wanted to go back there if I possibly can. There's been countless debates, Stephen, and papers written regarding investment diversification. At Blue Whale, there appears to be a tendency for your fund to hold around 30 stocks or so. Please, could you explain why that level? How do you maintain that number? And when you and your team find a potential new winner, how do you go about adding that to the portfolio at a reasonable price and keeping the number and maintaining the actual diversification?
Yeah, this is a very good point. I could definitely expand on that. So the other kind of the moving part within how one can deliver significant outperformance is that you need to run a highly concentrated portfolio. because I think with the exception, I think I'm right to say that with the exception of Bailey Giffords, which tend to run probably around 100 companies, but I mean, I think they are quite different beasts. Most other fund managers in my peer group, that you tend not to do too well versus the market if you have too many stocks in your fund. Because if you ask any manager that have, let's say, 75 holdings in their fund, how do they justify their conviction? Surely that is impossible. They would have the same level of conviction on the 75th holding versus the top 10 holding. And I think there's always one of these things like we are all human at the end of the day. I mean, we are not like a super, I don't know, like a super computer that we can just analyze anything and be able to understand anything. There's a bit of limitation in terms of everyone's career or know-how or knowledge base or how their intellect are shaped. And ultimately you need to work out what you can do well and what you can't do well within the stock market. Because ultimately, if you look at the MSCI World Index as a proxy for the world's stock market, there are about 1,600 stocks. I mean, just tell me that can anyone, follow the 1,600 stocks to start with. Secondly, to understand every single industry that these 1,600 stocks are operating in globally across geographies is impossible. But and also at the same time, I mean, there's some areas that would never touch, such as banks. I think throughout my career, I mean, in my previous career, I have invested in banks. But then I think over the years, you learn that there's no one that can get behind the balance sheet of a bank, like even the management couldn't. And in order to run a high conviction portfolio that say, okay, why don't we pick, I mean, whether you pick like Lloyds Bank or Citibank, like you never know what goes on behind the scene, right? Like, okay, I can share the view that maybe people use the bank to play on the interest rate cycle, that okay, interest rates going up, let's buy some banks, maybe you make some money. But I think equally you could lose money for other reasons, such as if our audience follow what happened to Credit Suisse or Deutsche Bank in Europe. And I think it's not just as simple as investing in the bank on the back of the interest rate going up. So I think there's certain sectors that we decided we are not going into. And then the other sectors would be the likes of oil and gas company or mining company. It's not like these companies are bad company. I think some of the market leader are good companies. But then because they can't really control the price of their product, which is, let's say, the oil price or maybe the iron ore or copper, then if the market is not going in the direction in terms of those product prices, then they won't be able to influence that. At the moment, yes, those prices are going high, but it could go the other way around, as we all know. It goes through cycle. And so I think one should start filtering out sectors that we don't think we could add value on. Then you ended up with a number of sectors that we feel actually, these are the sectors that we understand, these are the sectors that we feel we could add value through our research. And they would be the likes of some financial, excluding banks, let's say index providers, financial services, payment providers, or the card network like MasterCard or Visa. And at the same time, luxury brands, consumer staples company, medical equipment company, and obviously then we also have the technology company such as Google or Microsoft, etc. And I think there's still quite a lot of companies that we can cover, and we feel that we can add value in these companies.
It's interesting there, Stephen, because what you've done there is obviously found your universe, but I've read numerous times where people are trying to lump a lot of the tech companies that you've purchased all in the same little ballpark, and there's so much diversification amongst them regarding software services, regarding payment companies, and so on and so forth, whether they're in financial or digital content, for instance. So you have got quite a lot of diversification. So I wanted to add on that and ask you, with regards to the research that goes in to differentiate these companies so they're not overlapping too much, how much work is involved? You said about brain power before. How much work is involved in actually selecting that one stock out of that whole universe of stocks?
Yeah, I mean, this is what we do on a day-to-day basis in terms of researching our companies. And so if you think about I mean, sorry, if I give you some color in terms of how we go about researching a company, is that we start with the primary sources. I mean, I already mentioned that we don't speak to any sell side analysts, so we are not going to get their research report to understand what this company does. I mean, we go back to the primary sources such as annual reports, conferences, transcript, and you'll be surprised. I'm sure our audience, if you are a DIY investor, you should not be surprised how much information is out there now compared to when I first started my career, that you could hardly Google what happened to this company. But nowadays, like, you could find so much stuff online for at least bigger companies, and there's a lot of cross-referencing at the same time. Like, you can easily be doing work on Microsoft, but then you will also be doing work on their competitors and trying to find out what's going on, the market share. Do people like the product in terms of the star rating? Even like software, they have some sort of star rating. You can look at the kind of the ex-employee survey or the view of the management team, whether they like the company. There's a lot of these things going on out there, and it's quite interesting. Then at the same time, you can look at job posting to see whether the certain industry is hiring more people, etc., or using the products, or that those products would be part of their kind of the hiring requirement, etc. So I think there's a lot of things out there. And ultimately, I think if you think about, I mean, I gave you this example before, like, so what does it mean to have 5 people in the team, let's say, versus maybe 2 people in the team and running more stocks? And if I'm just making this number up now, but it's a typical setup in our industry. Like, typically you would easily have 2 people in the team running about maybe 70 stocks portfolio, which is not unusual, because a high conviction portfolio of about 25 to 30 companies is unusual. Because I could definitely, I mean, our audience should know that I think in the UK, the really well-respected and successful manager would be Terry Smith of Fundsmith and Nick Train of Lindsay Train. But then you can't actually name many others that are running only a 25 stock portfolio. And hopefully, I mean, Blue Whale is trying to do something similar. And so if you have 2 people running 75 stocks and assuming that individually they work maybe 10 hours a day, just focusing on the portfolio, then I worked out that on average, between the 2 team members, you spend about 5 hours a day. Sorry, you spend 5 hours per holding per month between the 2. So 5 hours per holding per month. And then once you spend that 5 hours, you move to the next holdings. And by the time you get to 75 holdings, that's 1 month for you. And then if then you do the same exercise for the team at Blue Whale, on average, we invest into around 25 stocks. At the moment in the fund is 25. 5 people, same calculation, 10 hours a day. Then on average, we'll be spending about 40 hours per holding per month. So 8 times more, irrespective whether we are smarter or not. Maybe we are just the same. Maybe we are not that smart. But if we can spend 8 times more, 40 hours versus 5 hours per company per month, then it means that there's a lot of research that we are able to go through than you, because like ultimately 5 hours is not a lot. Everyone would say they read annual reports. We do too. We do nothing different, but we just meet and ended up reading a few more than our competitor, right? Like if you have 40 hours, you can read at least like 5 reports more than you only have 5 hours. So I think there's no magic behind what we do, and at the same time, which is equally important, we could touch on this as well. Recently, we managed to sell out of both Facebook and PayPal before their results. And obviously, if you follow the 2 stocks, I think the shares collapsed about 30% since they reported. And obviously, if you also follow the fund, the Blue Whale fund, is we have had both companies in the fund since we started in 2007. So these 2 holdings are not new to us. We have done a lot of work. And the other thing people tend to underestimate is the amount of time, not just about getting a company into your fund is required. Obviously, that requires a lot of research before we get to a level of conviction that we want to buy this company into the fund. But at the same time, the ongoing research, which is never ending. Things change, things evolve, competitive landscape evolve, the management team could change direction, such as what happened to Facebook in the metaverse, spend, etc. And I think if and I think the ongoing research is equally important than just the initial research. And there's no answer to it, but ultimately, if you have a team of people just focusing on at about like 25, 30 companies, I think you probably would hope that you understand the company a bit better than your competitors who hasn't spent as much time. I'm sure they will get there at some point, but then maybe the share price is already reacted.
Absolutely. You touched on a beautiful point there about the quality and also the quantity and the importance of research, and the importance of the signs were there, and you and the team at Blue Whale spotted those signs. There's some fund managers have been adding to those exits that you've made over the past 3 to 6 months. The ones that you've made recently, they've been adding all along. So it's just very, very important, I think, to actually point that out. But I wanted to just touch on a little bit regarding some of the exits and the nuance that you and your team saw to enable you to think, actually, we're meeting this month, let's have a really good look at what's going on here, because things are changing slightly. And you and the team were ahead of the pack, and some of them are still considering what to do, and they're still holding. A lot of the hedge funds, a lot of the fund managers are still holding those holdings. So could you just touch on a little things that you saw that some people didn't see and still don't see?
Yeah, I think ultimately we do not have a crystal ball, right?
Oh, I know.
We if we knew like Facebook shares and PayPal shares are going to be down 30%, we would have exited maybe 3 months ago, not just before the result, right? So that the severity of that sell-off is a bit unexpected, but obviously we didn't expect it to be good, but that bad is slightly unexpected. But I think this is the thing, isn't it? Like I have always said this is like we are not doing anything different to any investors, like including our competitors. But it's just if you have a team of people that are quite focused, and then you do your work a bit better, or you take your work quite seriously because you're investing your clients' money into the stocks that is based on our research, then I think the ultimate advantage that we get is you are able to act a bit quicker, hopefully quicker, before your competitor does. Because like nowadays, I'm sure loads of team will be discussing what are we going to do with Facebook and PayPal. Should we buy more? Should we exit now? Oh, the shares is already down so much. Surely maybe it's too late or whatever. I don't know. But ultimately in the stock market, in addition to investing for the long term, sometimes I think spotting the changes or disruption that could take place, that if you can spot that a bit sooner, then I think there's a lot of alpha or outperformance that you can capture by avoiding the kind of disaster. And I think for Facebook and PayPal are definitely one of those examples that we can reference to. But I'm sure that there will be other names that, let's say, I don't know whether you have Amazon on your list that we want to talk about. Like we exited Amazon in December. Obviously, one of our competitors have recently acquired Amazon. And I think if you track the results wasn't that great, actually. I think the good news on the back of the result was they managed to raise the Prime membership prices. But some people actually asked me after they reported, oh, do you have any regrets of selling our Amazon? We have no regret, because everything that we were concerned about are still in place. It just didn't materialize in the quarter or on the day that it got reported. But then for Facebook and PayPal, it did. So let's see whether we are right or wrong on Amazon. But I think that particular day when the share was recover or went up 10%, I think we have no regret, because it was a right decision to sell it on the fundamentals based on the research that we have gone through. And at some point it could happen, or maybe we would be wrong. But these kind of things, it's like you just as an investor I think hindsight is a beautiful thing, because like you can always look back at this to say, oh, this is what we should have done. This is like something that we should have avoided, but you never have that luxury of that crystal ball. And then it's over time, that over a long period of time, at least I think for us, we've been running the fund for about 4.5 years. I think look back at a time, I think we just managed to get more things right than wrong. There will be many things that we got it wrong and just but it doesn't show up in the performance, because over time, if you get more things right, then you would do better than your competitors.
Indeed. I mean, there's a famous quote from Peter Bernstein, the American financial historian, economist, and educator, and he's quoted as saying, "The fundamental law of investing is the uncertainty of the future." So that sits well with all the different things you just said there, which is you said beautifully. So with interest rates and inflationary environment rising, all the metrics and all the fundamentals have gone completely out the window of late, Stephen, yeah? And Blue Whale has been assessing some of this absolutely on point, and the tech growth and tech stocks going forward have been impacted, and you've been very, very nimble. And I've noted recently, obviously we just touched on you exited Amazon, you went head to head with Visa, and you exited Amazon, but you kept Visa, which I thought was very, very interesting going forward. And also before that, you'd already exited MasterCard. What was it about Visa that you saw or do see going forward that as to reasons why you kept that?
I think it's actually the other way around. We exited Visa, but we have kept MasterCard in the fund. So,
sorry, apologies.
No, that's fine. So basically, we do like the payment space. I think we like obviously, I think the competitive positioning of both Visa and MasterCard. And I think what we didn't like for these two companies previously was that because they are, in terms of their business, they do make quite a lot of money from cross borders or international travel. And obviously throughout the last 2 years, you would have thought like maybe we would have a bit of like a recovery sometime earlier last year than now. Then it just get postponed continuously until recently that I think people are allowed to go on holidays with more choices, etc. So I think that is something that we didn't like, and hence we decided to consolidate our position into one over just having two companies in the fund, and then we decided to pick MasterCard rather than Visa. But the thing about Visa versus MasterCard is I think the thing is, if you follow this company, Visa is the market leader in the US. It's a bit bigger as a company. It's very difficult to argue that Visa in itself is not a high quality business. But then if you follow these two companies quite closely, then you would have probably share our conclusion that MasterCard is marginally a more innovative company. I think it managed to, it has taken share from some of the Visa's customer. I think in the UK, they have got Santander a few years ago. And I think MasterCard have now gone into some sort of crypto or facilitating some sort of crypto platform, doing transactions and all that stuff. They're all marginal stuff, as in like, it's not going to change the numbers materially because it's still quite a subset of the market. But on the other hand, like Visa has always been the incumbents because they're really big. They could be quite slow moving, etc. And I think what was quite interesting was, I think if you look at the route between Amazon and Visa, that wasn't the reason that we're selling out, because ultimately Amazon would still need to have some sort of Visa network behind it, because otherwise then half of the American population can't pay for their goods on Amazon. So that is just a route, but I think it just shows you that Visa is kind of on a relative basis a bit slower versus MasterCard, but I think that both of them are quite good companies. So
thank you for that. All right, continuing on the current macro environment, Stephen, you purchased Charles Schwab, which you see as a potential beneficiary of the rising interest rate environment. Having exited PayPal and Meta and Facebook, please could you expand on the metrics or what your team are seeing as to why this could be a beneficiary? Obviously, interest rates, amount of cash they've got on the books, etc.
Yeah, so I touched on earlier about that we are not interested in banks, because banks is quite low quality in a way that you can't get behind the balance sheet. But then obviously we do recognize that the interest rate is going up, which is not a surprise. And we do want to have some company that could benefit on the back of the rising interest rate. But at the same time, you don't want to trade off the quality of the business. Hence, we would not be interested in a bank. I think if you follow Charles Schwab, which is the largest investment platform in the US, is actually a good company. Is actually a fine company. The first thing is the customer base is very sticky, because on average, I think the age group bracket will be over 50. Secondly, if you look at the average portfolio size of these people, they are over $200K put individually on a platform. In contrast, that we were looking at Robinhood, which would never interest us, but just part of our research, I think that number is probably like a few $1,000 or $1,000 to $2,000, which is really small. It's really like people using probably using their furlough money to open an account on Robinhood while they're sitting at home. So anyway, but if you look at what happened to Robinhood's share price, you probably give you a good idea where this company is heading. It might disappear because they don't have the scale, and also it's never that profitable to start with. But then it doesn't actually change anything for Charles Schwab. And at the same time, because majority of people in the US, I'm sure it will be similar in the UK, is for any typical investor, you never, even though that I'm sure you have other assets outside of the investment platform, you never are truly invested in the stock market or the bond market. So in the US, as far as the Charles Schwab customers are concerned, they on average, they are holding about 10% cash with Charles Schwab, paying nothing. So the customer get nothing from Charles Schwab. And obviously then Charles Schwab could use that money to invest into interest paying products such as the bond market, et cetera, et cetera. And then if the interest rate goes up, then they make more money on the back of that. Ultimately, they will still pay a bit to the customers. But I think that differential, as we all know, if anyone have any money part in cash with a bank, we know that we're not getting a lot for the money that we could get investing directly, etc. So I think that is that. But at the same time, I think if you look at the structural growth driver behind Charles Schwab, is not so much just about the interest rate going up. At the same time, we do know for a fact that the American economy has been doing pretty well, and over time it will continue to do pretty well because of the innovation, the entrepreneurial setup, culture in the US. And then if you believe that the US economy over time would do well, then the nation is going to be wealthier and more money is going to park with Charles Schwab. So hence you will see, even without the interest rate going up, the asset size or how much they manage over time would trend upwards. This is how it works, because they're the largest platform to capture the wealth. And last but not least, if you look at the recent acquisition that they made, which is to acquire a TD Ameritrade in the US, is one of the top competitors that have strengthened their competitive positioning. Luckily, they were allowed to do that, and there's a lot of synergies behind the scene. And then if you put all this together, then the valuation is looking quite attractive. So it's not just purely on the back of the interest rate going up. Surely we like that. I mean, we probably don't want it to be the other way around, right? If the rates is now going down, or we are going into a cycle of quantitative easing, then even though with all these structural drivers might not be that interesting in valuation terms, but then I think when you have all these things going in the right direction, then it would be quite beneficial.
No, thank you for that response. And I appreciate the fact that you've gone into the financial sector and you still managed to avoid the banks, which is a really sensible thing to do. Right, Stephen, we've had Web 1.0 in the 90s, which is essentially basic HTML, email, etc., read only. Then the internet evolved into Web 2.0 and started the century information centric, and now we're seeing fast flowing interactions, transactions, quantum computing, machine learning, etc., artificial intelligence. Vaccines even developed in less than 18 months rather than 10 years. Now, essentially, we're talking about Web 3.0, decentralized, private, secure web evolving. Which companies do you think could be the winners and why? And how is BUL going to capitalize on it?
That is very difficult I truly agree, and I strongly believe in this Web 3.0 and what's going on now. I think the problem with the public domain, company listed in the public domain, is you tend not to get too many of these companies when the technology is at a really early stage, but we do, as a team, that we do follow the development quite closely in terms of what's going on in the crypto market, the blockchain market. And over time, I think what we see, hopefully, I mean, at some point, that will be certain company in the stock market that could capture some of this, but not at the moment, is I think that would be increasingly many more applications that will be built on top of this rail. Because I think if you ask me what am I believe in Bitcoin, I'm not a believer in Bitcoin, because Bitcoin in itself have no use. There's no usage on the back of just some people call that as like a digital gold, which means doing nothing. Like even if you have like a like some gold coins like sitting under your bed, I mean, that's no use to it. Like it's just like so hence there's no application can be built on that. And then, but if you compare what's happening within the crypto or the blockchain space at the moment versus when we first have the internet back in the 1990s, then so many companies that haven't existed at the time now have become really big company. Like for example, like even we have exited Facebook or like the company, but then at the time that wouldn't have Facebook. Facebook wasn't even started at the time, and then Facebook as part of the Facebook group, they also own WhatsApp. And WhatsApp wasn't existed at the time because we didn't have the internet connection. Even Netflix already started then, but it was still selling DVDs on the internet or something. It wasn't the streaming Netflix that we know of now. But obviously these companies are very sizable now, or very important in terms of influence and how we conduct our day-to-day life. But it wasn't possible when the internet speed was still really slow. I mean, I remember I'm sure you remember as well, you dial into your modem, you connect to a phone line, and the internet speed, it takes you probably, 10 minutes to load a page on Amazon website. By the time you check out, it probably takes you an hour. Now it takes seconds, like on your smartphone, etc. So I think it's something that we do follow quite closely. But I think the short answer is there anything that we could invest into the stock market now? I think it's very little, because it's still not proven. And a lot of the things that are developing now is definitely, we don't think they are the answer to what we are going to experience. Maybe it will link up with the metaverse at some point, who knows, but metaverse is not here yet. So I think it takes time for that to develop. But I think the other side of this research is that you want to monitor whether it's going to cause any disruption to our existing companies. Because one thing that we think is a big threat to MasterCard or Visa, which is not imminent, but it could come 5 to 10 years later, is whether we would be conducting our day-to-day transaction through crypto, right? You don't need to conduct 100% of a transaction, but let's say if you conduct like 1/3 of your transaction using the crypto network, then that money is not going through the MasterCard and Visa network anymore. And someone is going to make less money, right? So I think that is something that we do monitor closely, even though that, we haven't got the direct opportunity to invest into at the moment.
You've almost answered the question I was about to ask you, Stephen. The question, I'll pose it anyway. It does appear that virtual currencies are going to be required for the metaverse to thrive. If so, which payment companies currently have a head start? Or will the current payment incumbents see their lunch being eaten by the new innovative payment companies, much like we're seeing Visa, MasterCard, and PayPal's dominance being eroded currently?
I think the answer is inevitable. Like we would ultimately have just maybe like a handful of companies that would be global in terms of scale and quite dominant, but it's just like when the journey is developing, it's impossible to pinpoint which one. And I think going back to our exit from on Facebook or Meta was that it's not like we disbelieve that metaverse is going to happen. It might happen 10 years from today or 20 years from today. I'm sure it will happen within my generation. But then the problem is you don't actually know whether the tens of billions of dollars that Facebook is going to spend on building the metaverse, are they guaranteed to become the winner on the back of this? Because as we know, Google is doing something, Apple is likely to come out with some sort of 3D glasses next year, and Microsoft is doing something as well. And ultimately, if you follow what goes on in the world, is like you have the payment network, which is only two company duopoly, is MasterCard or Visa. The mobile operating system is Google Android or Apple iOS. Anything else in the in the operating system, I'm sure you remember Microsoft did try to venture into mobile operating system. Sony has one, BlackBerry have one, like that. So many other. Where are they now? Like we don't even know. Like even search engine, like before Google started, Google only started as the 7th search engine on the internet. It wasn't the first, but where were the other 7 or 6 that started before Google? Like, many people wouldn't remember that if you've not gone through that generation. So the thing is, like, if you think about, we are now sitting in this massive opportunity, and I think unless that you are running a, I don't know, maybe a VC portfolio, but then I think even in the context of like a VC portfolio, it needs to be quite well diversified, which is not high conviction, which is completely the opposite of what we do. Because like, if you have to pick 25 companies in the space that are quite speculative and uncertain, you can't pick 25 companies on that. If you say, why don't you pick 100 or 200, then maybe you get something right. because that's the thing, right? That's the thing. Like, yeah. I mean, obviously, it's not my role to comment on Baillie Gifford, but I think if people are following what Baillie Gifford is doing, I think they have a lot of investment across many private companies, unlisted companies. But you don't just make 1 or 2. For every Amazon or Tesla that came out from their portfolio, I'm sure there are many others that we have never come across, but they did make an investment. I'm just speculating here, and I think that is what you do if you are going into the market that you can't actually be certain who is going to come out as a winner.
Yeah, no, I fully appreciate that, and thank you for that reply. I mean, within the metaverse, though, Stephen, one of the main things around it all is obviously digital content, and there's a race for digital content now. We've seen what's happening with regards to Microsoft buying Activision, etc., and the gaming side, they're going to go down. So you can see with that, and I'm looking at one of the winners that you've already got in your portfolio that could really, really do well, and that to me is one that very few people talk about that often, and that's Adobe, because it's involved in all different aspects of content and digital media.
Correct. We continue to like Adobe. I think Adobe has been one of the most beautiful company that we have ever invested, because it's quite clean. I mean, Microsoft is great, but then Microsoft is a bit more complicated in terms of the many different products that they have. But Adobe has always been one of our favorite and remain our top 10 holding since we started. And I think if you do follow Adobe, is the end market, which is something that we look at. People label Adobe as a tech company. Surely, it's a software company, is a subscription model in terms of the product that you subscribe. But if you follow the end market, it's all about content creation on the internet, the Instagram, the Photoshop, the video editing, and you would only get increasingly more of content being ever created and consumed at the same time compared to before, and that is not stopping, isn't it? Like, they just continue that journey. And if you look at the competitive positioning of Adobe, I mean, remain the market leader, owning about, I think, 60 to 70% of the market share. I think at the moment you do tend to see some smaller competitors creeping up, like maybe some free product that they offer, but then you never get the breadth if you really want to do something serious. I mean, you never get the breadth of the capability of software to do it. So I think we continue to like Adobe. I think one thing, if people follow the share price of Adobe, that the share price has not done that well recently over the last 3 to 6 months. And I think part of the reason is because sometimes I think the stock market want to have shorter term catalysts. Like, yes, everyone understood that over time, Adobe is going to capture a lot more of this content creation market. But then what do you have now? Like, I can't wait for like 3 years to get to that size. I mean, what do you have now? And I think if you have to follow Adobe, is like they have not had a price increase for a few years already. And if they do come to the market for a price increase, such as what Microsoft did, I mean, we're going to pay 15 to 20% more this year now if you're Office 365 subscribers, that Adobe has not done a price increase. And I think without a significant price increase, which we expect them to do in time, then you don't have shorter term catalysts. And I think that sometimes the stock market just got bored. Like, say, yeah, everyone understood the story, but the market tend to underestimate the kind of the longevity and the potential TAM of that market over the medium term with little disruption. So we continue to like Adobe. Hopefully they might increase the prices, and I think that could be a catalyst.
And another company which is completely off most UK and global investors that you have within your portfolio, Stephen, is Atlassian. It's not a company. I think I know a lot about tech stocks, and I do a lot of research myself. But even that one was off my radar. And you guys have got it in your portfolio. You've held it for a little while. It's done extremely well. Please, could you tell us about that company and what attracted you guys, Blue Whale, to that particular company and what it does?
Yeah. This company is not, I think, not well known outside of the end user base, which I'm going to come into. So it's a software company, which we like, because the one good thing about software company is they have a scalable distribution platform. So they want to roll out new products. Nowadays, everything is on cloud. You just need to press a button, you get updated. If they want to roll out a new addition, I mean, like they want to introduce you to some capabilities or new products, they can just press a button and you will be seeing on your screen. At the same time, if they want to raise prices, it's all recurring revenue stream. As soon as you stop paying, if you don't like that, then your software stop working, which is quite powerful. And so software in itself is something that we always like. But obviously, we then want to go into the end market to say, okay, is the end market interesting enough in terms of structural growth, etc. And then for Adobe would be the content creation we already talked about. For Atlassian, the end user are software developers. So the Atlassian product, the Jira, which is widely used within the software developer space, is a bit like our Teams. If people have used Teams or Slack, is how like a small group of people or developers work together to basically code certain capability of a bigger piece of the program. And then there's obviously a lot of debugging, a lot of improvement. There are a lot of things you need to track. You can't just say, I changed the code and without telling anyone that you have done it, right? Because it could affect other parts of the program. So there's a lot of tracking, a lot of debugging. And if you change something, it could affect other parts of the program. And then there's a lot of back and forth. And so basically, once you adopted the software to develop certain software or programs, then the switching cost again is going to be very high, because you can't just bin that and go somewhere else. And I think people notice already that we are in a period that we not only that software developers is probably the highest pay job out there. At the same time, I think they are in demand as in like the shortage of software developers is huge. And over time, you just expect that anyone or in any company, you would expect many more software developers compared to before, and then that a lot of these people would be using Atlassian product. And then the other funny thing about Atlassian is, I think when we kind of first look into the company, is like they recently have done a 5 times increase in prices in terms of subscription. And then you think like 5 times increase, that's a lot. But what that actually meant was like they were previously undercharging the user at about $2 a month, and now they're charging about $10 a month. But that's 5 times increase, and obviously, as a company, you make 5 times more when you go into a subscription model. So I think that plays a role into the valuation of Atlassian as well, because I think is once you get into a nitty-gritty, then you still want to invest into the shares when it's kind of cheap or you have a differentiated angle, which is not expected by the market yet.
Brilliant. I think that was a really good purchase of yours, because it's not one of those companies that I've seen that lots of other hedge funds or fund managers are involved in. It's like, what did he see? So you've got that one there. So that's absolutely phenomenal. Now, Stephen, I've got one more question for you before we finish. And for me, you founded Blue Whale in 2017. There's always been talk or speculation. You've been ever so successful. You're focused, and that's the reason why you've been so successful. But what are your ambitions and goals for Blue Whale? Could there be another fund launched by Blue Whale in the future? What's your thinking?
Thank you for that. So I think we are still relatively young as a company. I think there's a lot more to go and a lot more to prove as a company or as a product. And I think one thing that I think I already spoken about this before is for us or for myself, I truly believe in a high conviction product for our potential investor base. And I think what happened over the last 5 to 10 years is we have increasingly see a lot of disruption from passive trackers. And I think rightly so, they should be taking share from the active managers, because many active managers have not done well. Many active managers have been running overly diversified portfolio with not a lot of outperformance, and I think a lot of them ended up to be underperforming. Then I think some people have just taken a view that maybe we should go with trackers, we should just go with ETF, that we should just forget about the active managers. And I think what we're trying to do here is we want to show that if you have got the right ingredient, running a high conviction portfolio, doing all the research in-house, being really focused, then at least we can offer the investor the significant outperformance potential. Obviously, we do get it wrong as well, and we do believe that there's a role for passive, but ultimately, passive tracker would never outperform the market. But equally, if you don't invest into a high conviction portfolio, which we believe into, then unlikely you're going to get significant outperformance if you get it right. And so I think over time that if we could probably continue to do well, then we could demonstrate to the market there's a role for active managers, but it's not every active strategy. I think the last one about product, I think there's been some speculation, or we have considered maybe doing an investment trust at some point. I think the timing is not imminent, because one of the things that the same thing as we talk about investment is you need to be quite focused. And obviously we are interested, but it's not like we want to be distracted. And when we're ready, then if there's enough interest, then we might consider it. It's going to be different. I mean, I'm sure some of your audience here would be keen for investment trust rather than open-ended. But at the moment, we're still relatively small or new to the market. So over time, that I think is something that we will consider.
Thank you for your candid reply. I really appreciate that, Stephen. Now, you touched on outperformance and overperformance. We've not touched on the metrics, and I will add this last question then to show the outperformance of your fund, how it's exceeded the peers and what it's done since inception. Could you just share those metrics with me, please?
Yeah, so I think I have to caveat that recently we have given back a lot of performance, if you've seen what happened in the stock market or if you follow the NAV of the fund. But before the recent sell-off, I mean, maybe just 2 months ago, that we have managed to deliver in the range of 5 to 10% better than majority of our competitors. So in the UK space, you probably would be using the IA Global, which is the average performance of the about 200-300 funds, global funds in the market. And over time, we want to do at least 5 to 10% better than our peers. And I think we have managed to do that until recently. And I think even you include the recent sell-off, we are still just short of about 5%. So we don't deem that performance to be acceptable, because I think that is not what we try to achieve. But then sometimes I think the stock market could be quite volatile. But then if you look at the long-term trend, I think 5 to 10% is what we expect that we can do better than what the general stock market could achieve.
Thank you, Stephen. Cha-cha, Stephen. That was Stephen Yiu. Thank you, Stephen, for sharing your investing insights and wisdom with the London South East Investing Matters Global podcast audience. It's been an absolute pleasure speaking to you, Stephen. Thank you ever so much.
Thank you, Peter.